My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. It's a really cool series to see how different people all across the globe are investing in this type of strategy. Dividend growth investing is for everyone. It really doesn't matter what your time horizon is. There's something for everyone in terms of generating passive income or cash flow from your dividend growth portfolio. My portfolio here in M1 Finance serves a very specific goal. My goal with my dividend portfolio is to reach financial independence and retire early. Really, the emphasis is on financial independence because that really is what it's all about. It's about giving us time back and buying our freedom with our portfolio. It might sound a little bit weird, but yeah, we're really trying to buy our freedom so that we can choose what we do. I think a lot of people think about, the FIRE movement as, it's binary. It's, you reach the goal, you retire, and that's the end of it. No, financial independence is all about giving you options and freedom to choose how you spend your time and what you do with your time. This portfolio that I share here on YouTube serves a very, very specific goal for my wife and I. Our situation is very different than a lot of people following the channel. Many of you watching this video are in a very different situation than my wife and I. You may have a time horizon of 20, 30, or 40 years. You've heard me many times on the channel say that it all depends on your time horizon. That's what it all comes down to. What you don't want to do is you don't want to look at my portfolio as a standalone one-size-fits-all approach. This portfolio is very specific to my wife and I, given our time horizon. But as I mentioned, this portfolio is really for my wife and I. I got really interesting questions from the same person here yesterday asking about, different time horizons. A lot of people following the channel see my portfolio and maybe are enticed to just copy it, right? And I think, it's not a bad place to start, but it's very, very important that you understand what your goals are. And this individual that was writing was saying that, hey, they copied or they made a version of my portfolio, but found out that actually this is not really the optimal approach to investing or dividend investing for them because their time horizon was over 40 years. And so I think that is so important. I just want to remind everybody that when you see my portfolio, that you understand that it's not black and white, that it's not one size fits all. It really depends on your time horizon. If you're having a difficult time starting and building out your portfolio based off of your time horizon, I made an entire video about a year ago specifically addressing this question. This video is really meant to help get you started to start thinking about different time horizons and different growth rates. The portfolios or the different slices in this video are just mere examples that you can build off of. But if you're really unsure of how to invest based off of your time horizon, I really would recommend you check out this video. I will leave a link in the top right to this video that you can check out after watching this video. And that's one of the cool things about having a YouTube channel is interacting with different people and hearing different viewpoints on investing. Many times we're talking about the same thing, whether we're investing in one stock or another stock or having one approach versus another approach. Oftentimes we're speaking about the same thing, but we're sharing it in maybe a different language or in a different way of phrasing it. And it can feel a little like this.
You know where the avocados are?
No idea what you're saying. Have you asked him?
Avocados?
Avocado?
Oh, avocado, yeah. You know where the salami is?
What is it?
Sliced meat.
Oh, salami.
Salami, yeah.
He wanted salami.
How much does the filet mignon cost?
Filet mignon?
Yeah, filet mignon. You don't sell lasagna, do you?
You're not talking lasagna.
Lasagna, yeah.
Don't pronounce the G.
Do you sell zucchini?
Zucchini?
Yeah, zucchini.
Zucchini.
Yeah.
Zucchini.
Oh.
Yeah, not China.
Oh my gosh, avocados. Zucchini. I think my favorite was the avocados. Which one was your favorite? All right, in today's video, we're going to review 4 portfolios. The first portfolio is going to be from a 32-year-old in the United States, the second, a 44-year-old in the US, the third, a 25-year-old from Germany, and then the fourth, a 28-year-old from the United States. The timestamps will be in the description below, as well as the links to the portfolios will be in the description. And as always, everybody, I'm not a financial advisor, so don't take what I'm saying as financial advice. It's just merely for your entertainment. All right, the first portfolio is from Tyler. Tyler writes, "Hello, Jake. I hope things are going well down in Austin. My name is Tyler. I'm a newer investor and a new subscriber to your channel. Stumbling upon the dividend growth investing strategy has completely changed the way that I view investing, and your channel has been so helpful to set me up on the right path. Thank you for all of your insights and for being so interactive with your audience. I'm a big fan of the Review My Pie series and hope you you will consider taking a look at mine. Well, hey, Tyler, thank you so much, man. I really appreciate it. I'm 32 years old from North Carolina with a 20-year plus time horizon. My goal is to use my dividends as supplemental income. My dividend portfolio is a taxable M1 finance account that I recently started with $2,000. I'm funding it with $50 a week and hope to increase that in the future, as well as purchase additional shares when I have disposable income. I also have a Roth IRA through M1. That is my primary retirement account, and do not intend to use my dividend portfolio to achieve FIRE, as it sadly would be an unrealistic goal for me. Okay. One interesting thing about my portfolio is that I managed to get an even distribution of quarterly dividend payouts. 12 of them start in January, 12 in February, 12 in March, and 1 monthly. And Disney's biannual if they start paying it again, fingers crossed. I'd like to get your opinion on how important or useful this is if you intend to never sell your shares and intend to have steady, consistent income from them in the future. I'd also love to hear your opinion on my current low dividend yield. I'm aiming at a longer time horizon, but I'm still concerned that maybe I need to bump it up a bit in the short term. Please talk some sense into me. Thank you so much for everything you do. So first off, you understand your time horizon. That is so important. So if you know that you're going to have the goal of supplementing your income in the next 20 years, you can build your portfolio in a way so that it gives you options down the road. So 20 years is a long time. So you really want to skew towards growth. There's a couple reasons why you want to skew towards growth, especially if this is in a taxable account. You want to optimize it for tax efficiency. So you don't want bonds, you don't want REITs. You want to focus on qualified dividends. So that's the first thing in your taxable account, because you don't want it to be an unnecessary tax burden, especially if it's just going to supplement your income. You're going to have maybe a W-2 job, you're going to have a side hustle, etc. I think the important thing here is you say that it's an unrealistic goal to reach FIRE. I would challenge you on this. Every single day, just think about what you can do to focus on those three things that I talk about. Where can you cut your expenses? Where can how can you stay out of consumer debt, right? Don't buy that brand new BMW on credit, if you don't have to. And then the third thing is where can you make more money, right? Do you currently live in a home that's too expensive for you? Do you need to downsize? Do you need to maybe house hack or something? What can you do to increase income? Or where can you save some money on a monthly basis? Really starting there. And what you'll notice is you'll be surprised how just a couple $100 a month, how far that will go in the next 20 years. So that's the first thing. When it comes to the monthly payout of your dividend, the important thing there is don't invest into a subpar investment just because of the payout schedule. Invest into an investment because it's a good investment. That's my opinion on that. So let's take a look at your portfolio. For whatever reason, I can't see the historical performance. This is kind of a weird thing that's going on with M1. Sometimes it works, sometimes it doesn't. You have a good, decent dividend yield. This dividend yield is slightly higher than the S&P 500. I unfortunately can't see the historical performance. We'll probably see a little bit in the individual slices. You're heavier in tech, which is a good thing for a 20-year time horizon. Consumer discretionary is also good with a longer time horizon. Industrials, healthcare, you do have some real estate. So if you're not planning on really living off of this portfolio in early retirement, you may even want to consider maybe just completely getting rid of real estate in your taxable account and just put it in your Roth IRA. I mean, if you don't plan on really living off of the dividend income before the age of 59 and a half, I mean, that's a tax saving immediately that you'll see. But that's something that you can consider. And then you go all the way down here to telecom and basic materials. So let's take a look at tech. You also have it very well allocated in terms of the allocation. Having 20% in one sector, one industry is completely fine. So in your technology, you got your NVIDIAs, Microsoft, Apple, Visa, and MasterCard. These are really high quality growth stocks, right? I think this is completely fine. I don't know what's in your Roth IRA. The way that I invest in my portfolio, in my taxable account, it's more skewed towards individual companies. And in my Roth IRA, I just have high quality ETFs. So that would be a question is, well, how is your Roth IRA set up? Does it make sense to potentially add an ETF in here? My favorite technology ETF is VGT from Vanguard, something that you may want to check out. Just Consumer discretionary, you got the Disneys in here. Yeah, Disney does pay biannually. It's not really the most attractive in terms of the dividend, but I think from a total return over the next 20 years, I think Disney is going to really, really perform well. These are all high quality companies: Nike, Home Depot, Target. One that you can maybe consider is McDonald's. McDonald's is a really, really great consumer discretionary, but these are all really great companies. They're well allocated. I think this is fine. You're not gonna, you're gonna need at least 20 years, maybe even longer than 20 years to be able to live off of the dividend income and not sell your shares. So the thing is you don't know where you're gonna be in 20 years. Focusing this slice right here is focused on the total return. What I like about the total return with a long-term time horizon is this portfolio is going to balloon, is going to explode in value. And then you could always, if you needed to, if things in your life change, you could always sell out of one of these holdings or trim the holding and then reinvest into a higher yielding stock, maybe like a Verizon or a Coca-Cola or Kimberly-Clark, etc. So, but I think that as you have it here, I think it's fine. Industrials, I love seeing Waste Management in here. This is great. UPS, Caterpillar, Deere, 3M, all really well-established companies. This right here is like comparable to the S&P 500. I like this slice. I think this is fine, especially for your time horizon. Now you have Waste Management higher and then 3M lower. See, we talk about time horizon. With my time horizon being just under 5 years, I have this reversed. I am higher in 3M, but lower in Waste Management. So it's important that you understand that. It seems like you do. Healthcare, you got United Healthcare, Stryker, great company, Johnson & Johnson, AbbVie, Pfizer. Yeah, these are fine. The allocation is fine. I don't see anything wrong with this. I think this is fine. You also, once again, United Healthcare, Stryker, growing much faster than Pfizer, and you have Pfizer set up correctly. This is really, really good. Real estate, you got Prologis. Okay, you've definitely been watching my channel. This is amazing. These are the best of the best. You got Prologis, you got Digital Realty Trust, you got American Tower, you got WPC, you got Realty Income. You could also take a look at, you got industrials, you got data centers, you got cell towers, you got WPC. This is amazing. I love this. Just because these are such high quality companies, I don't know, me personally, the tax thing is an issue or is a concern or a topic that you may want to consider. But these companies, man, I'm invested into every single one of them. These are amazing companies. All right, consumer staples, Costco's, Altria, Cisco, Procter & Gamble, Coca-Cola. You're doing really well. Right? You got Procter & Gamble and Coca-Cola, great companies, but they grow much slower. So you want to focus higher on the Costco's of the world. And the cool thing about Altria Group is you get the best of both worlds. Altria Group is a sin stock, but in terms of a dividend growth investing, Altria Group is one of a kind. And it has a high growth rate and a high dividend yield. It's if it wasn't a sin stock, it would be like Coca-Cola, right? The way that it's valued. But because it is a sin stock, it is what it is. It's a unicorn unicorn dividend growth stock that is unfortunately not very, very liked, but understandably so. Utilities, you got Nexar Energy, American Waterworks, you got Duke, you got Consolidated Edison. Yeah, and you got to set up well. I think, man, I like it. I like it. This is great. JP Morgan, T. Rowe, traditional bank, you got an investment firm in here. This is fine. I think it's great. Telecom, Comcast, you got the highest. Verizon, AT&T. The only thing is, a lot has changed with AT&T. AT&T now is just a legacy telecom company like Verizon. I personally like Verizon better, but Comcast for your time horizon, amazing. Really, really great. Basic materials, Valvoline, okay. I personally like Air Products and Chemicals, for example. I like PPG. I'm invested in those two. I like Sherwin-Williams. I'm not invested in Sherwin-Williams, but it's another really good one for your time horizon. Tyler, this is a great portfolio. So here's the thing. You have all really high quality companies in here. I'm assuming you're getting very comparable results to the S&P 500. I think you know what you're doing. You're off to a really, really great start. The next thing that I would recommend you do, so I'd recommend two things. Take a look in your spare time. Don't try to overwhelm yourself. Do it maybe every week, every month. Look at a different company. Understand these companies that you're invested in, because it's always easy to invest in a bull market. But when you see the market correct, when you see that your healthcare stocks are down 30%, you want to know how these companies generate revenue. You want to feel comfortable that you understand these businesses. Otherwise, your emotions will take over and it's hard to hold on when the market is plummeting. Okay, that's the first thing. The second thing, as I mentioned, focus on those three things: cutting your expenses, looking for new ways to make more money, and staying out of consumer debt. If you do that, you'll be amazed at how fast your portfolio, your net worth will compound and grow. It's going to take sacrifice. But the question is what's important to you? What are your priorities? But it's definitely the slow and steady path to wealth. But thank you so much for sending over your portfolio. You're off to an amazing start. All right, let's take a look at the second portfolio here from Robert. Robert writes, "Hey Jake, my name is Robert. I'm 44 years old and just started investing. I've watched your videos for some time and have found inspiration. Thank you. I always thought it was too late to start. I plan on growing this portfolio over time, maxing out my Roth, then switching to my brokerage. I'm adding 250 to 300 a week. Any suggestions or tips would be helpful. I've spent days driving my wife crazy researching. My YouTube name is Gemini77. Hope all is well with the new addition to the family." Robert, thank you so much, man. This is so awesome to read this. We have our brand new baby boy. Well, he's not really brand new anymore. When I say brand new, it's like I just bought him at the grocery store. His name is Lucas. He's 6 months old now. I think so. Driving your wife crazy. My wife sent me a picture back from a couple years ago when I was really intensely researching stocks. I was building out spreadsheets, looking at the dividend rates, the growth rates. I was nerding out on it. And luckily I have a lot of support from my wife. I try to involve her as much as I can. She's not really into the nitty gritty. She's not as much of a nerd as I am when it comes to dividend investing, but she definitely supports. Let's take a look. So you have a plan. You got 250 to 300 a week. That is great. Think about it with investing. Think about it with like exercising, right? You don't have to go cold turkey and change everything up, because maybe it's not sustainable for you. Maybe all you need to do is just tweak a few things every day, maybe cut back a little bit, 100 calories. Maybe you don't have to cut back 500 calories, but maybe you cut back 100. Maybe there's something that you could do to improve your life and your finances just slowly week over week. And then you'll be amazed by how quickly that will compound over time. All right, let's take a look at your portfolio. This is in a Roth IRA. So you're 44, you got until you're 59, so about 15 years before you can start accessing this portfolio. You can always access the contributions, but the actual growth of the portfolio, you're going to want to wait about 15 years. You have 24 holdings. You have over a 5% dividend yield, a good expense ratio. This is really interesting. Okay, so you're really heavy in energy. You're heavy in healthcare, consumers. You got REITs, utilities, and covered ETFs. So this is covered calls, I'm assuming. All right, so energy, if you've been investing in energy for the last 8 years, you probably have been hating yourself. But if you've been holding on all this time, you're probably feeling pretty good. Energy is rebounding. It's taken, 8+ years, but energy is back. I don't know how long energy is going to be there, but let's take a look, be there in the sense of, the highest performing sector industry in the S&P 500 with financials, blah, blah, blah. So let's take a look. You got ENB, you got EPD, and Valero. All right, so the question is what is oil going to be doing in 15 years? Yeah, sure, you have a high dividend yield, but is oil going to continue to excel and do well in 15 years? I don't think oil is going anywhere anytime soon, but I do believe that there is a revolution when it comes to clean energy. especially in Europe and here in the United States. I don't know what it's going to look like in 15 years. I don't expect there's definitely not going to be the majority of cars on the road as EVs. But I think it's only a matter of time when we see that shift. For me personally, 19% in energy, I don't see this as a forever, allocation. Maybe, in the next 5 or so years, you dial that back down. I don't know. I personally, this is my opinion, I'm not the biggest fan of this. But who knows? I don't have a crystal ball. Healthcare, you got AbbVie, you got Pfizer, you got Gilead. These are great companies. AbbVie and Pfizer, these companies, yes, I strongly believe that they're going to be growing in 15 years. You could even take a look at Johnson & Johnson and have that as a lower position, right? Because it looks like you're going for the dividend. Let's take a look at your consumers. You got 7 in here. You got Kraft Heinz, Kimberly-Clark, Coca-Cola, Altria Group, PepsiCo, Kroger, British American Tobacco. So you got some traditional, consumer goods in here and CPGs and Kimberly-Clark. You got your Kraft Heinz, your Coca-Colas. You even have a few Sin stocks. 15 years, yeah. I mean, you're getting a good dividend yield. Maybe you could throw in some growth in here, right? The only one that I think you could maybe replace is Kraft. Kraft, I just am not the biggest fan of Kraft. I bought into Kraft years ago and I sold out after the dividend cut. Maybe there's another company out there that is growing its dividend that you could have as maybe as a growth, right? You look over the last 6 years, the last 5 years, since 2016, this portfolio, the share price is down. Now, the total return if you were to reinvest the dividend, then yes, obviously you're in the green. But maybe from a total returns perspective, there's another consumer company out there that you could take a look at that maybe is growing a little bit quicker. And if I were to replace one, me personally, I would maybe take a look at Kraft Heinz as maybe there's something else out there. Let's take a look at your REITs. You got Omega Healthcare, really, really great. You got a National Storage, okay, good. All right. So I really like WPC. I really like Omega Healthcare. I really like good. Another one you could take a look at is Realty Income. But yeah, my favorite REITs in here are Omega Healthcare, Good, and WPC from the bunch here. Let's take a look at your utilities. You got Southern and you got Nextera Energy. Yeah, these are two really, really great ones. So they're very different. When you look at Southern Company's got over a 4% dividend yield. It's growing decently, right? It's doing pretty well. But let's compare that with Nextera Energy. With Nextera Energy, it's night and day, right? Look at this. This is incredible. It has a much lower starting yield, but it's growing much faster. So I like that you have it in here. I think it's good to have a blended or a balanced approach between growth and value. And I think you capture that nicely with Southern Company and Nextera Energy. I think if you wanted to look at another one, I also like Duke Energy. Now let's take a look at your covered call ETFs. You got NUSI, you got RYLD, and you got JEPI. Yeah, I invest into NUSI, I invest into JEPI. I think these are both really, really great. I'm not as familiar with RYLD. I think this is like QYLD, but focused on the Russell 2000. I can't really speak much to this one because I have not researched this one in detail. But when it comes to NUSI and JEPI, I think those are great. All right, so Robert, as it stands, I think you built your portfolio for a reason. There's a reason why energy is in there at the highest for allocation. I'm assuming if you don't have full conviction in these 3 energy companies, I would maybe reconsider maybe lowering it. Maybe you lower it from 19 to maybe 10. Right? And you increase the other, slices that you maybe feel you have more conviction in. I think that may be something to consider. I think most people in their mid 40s, I don't know if investing so heavily in energy is the right approach. Yes, you're getting that massive dividend, but over the next 15 years, 20 years, 30 years, 40 years into your retirement, do you want to have the highest allocation in energy? I don't know. So those are my thoughts there. Thank you so much for sending over your portfolio. The third portfolio here is from Daniel. Daniel writes, "Hey Jake, after watching a lot of your videos and the Review My Pie series, I also wanted to submit my portfolio to hear what you're thinking on this and also maybe what the viewers will comment. I'm 25 years old, living in Germany, and started my portfolio in 2019. Before that, I had some mutual funds, but in 2019, I decided to sell them and do everything myself and create my own portfolio as I want. I invest around 1,700 euros per month. 1,600 euros is the base investment for my salary, and the extra 100 are reinvested dividends every month. As they grow, also the investment amount will grow. So far, the portfolio grew to an amount of 115K. Holy cow. I'm in the lucky situation having a good job with a good salary and will be able to keep the savings rate up high. In my portfolio, I combine 3 different strategies that will hopefully work out." Holy cow, Daniel, 115K at 25? That is incredible. All right, so let's take a look at your first strategy. The base of my portfolio are 12 ETFs. The core ETFs are MSCI World and MSCI World Momentum. The others have lower monthly savings rate, but I also see potential in each of these sectors. The monthly savings plan is 1,000 euros. The ETFs are. So I can't really go into the individual ETFs and really give an opinion because I don't know them. So I'm going to view this. The first one is all growth. Okay, growth ETFs. The second strategy is the dividend strategy. So far, they pay me a monthly dividend around 100 euros per month on average. I reinvest this dividend so far as I get no use from it right now. Well, yeah, because you have a job, you don't need it. That's cool. The monthly savings plan is 600 plus 100 euros. I completely build this strategy on stocks and not on an ETF. These are Johnson & Johnson, McDonald's, AT&T, Cisco, Realty Income, AbbVie, WPC Carry, love it, Unilever, Pepsi, Intel. Intel just got destroyed this week, but if you're long Intel, it's a great buying opportunity. Union Pacific, Broadcom, Digital Realty Trust. One thing, so you got some REITs in here. Be aware of the tax treatment for REITs as a German national investing into US REITs. You may have to pay higher taxes in Germany, or international tax. So for example, as a US citizen, I can invest into British, UK companies, pay 0 international tax. But if I invest into a REIT located in the UK, I have to pay international tax. So know your international taxes. Next are Energy, Amgen, Texas Instruments, Royal Dutch Shell, JP Morgan, Lockheed Martin, NXP Semiconductor, Iron Mountain. Okay, some more REITs. 3M, Emerson Electric, IBM, T-Rowe, Microsoft, ADP, Stryker, nice. Air Products and Chemicals, oh man, I love it. And McCormick. Okay, so these are great. What's cool about this is you have that balanced or that mixed approach, right? You have growth and you have value, and combined, you get a really healthy balance of dividend growth and current income. Okay, so this is great. So you have a plan here. The third thing is oh, look at these graphs here. We'll take a look at these in a second. The third strategy is stock picking for a few stocks where I see growth potential or stocks I like and will keep for a certain amount of time as long as the investment case exists. For each strategy, as well as the complete portfolio, I added pictures to this email. Thank you much in advance. Okay, so I don't think we're going to look at each individual one of these slices here. You can just kind of see, I guess, okay, so this is the total portfolio. You even got Activision in here. Okay. This is your overall portfolio with your 3 strategies. Your first strategy was growth ETFs. Second was dividend investing. And then the third, maybe stock picking. Maybe you're buying some Tesla or whatever in there for growth. Okay, this is really cool. This is very on brand for being a German. Germans are typically very well known for engineering. And I think you're definitely engineering your portfolio or your investments. I think this is great. Okay, so a couple of thoughts. I really like that you're breaking up your strategies in 3 different sections. This is not a one-size-fits-all approach, and I think you recognize that. So you have your growth ETFs, right? You have your stock picking, your fund, maybe your fund money or your mad money. And then your core, where you should spend the majority of your time should be maybe this is maybe not conventional thinking, but in all reality, the majority of your time should be spent hopefully on number 3. Now let me explain why. Your first strategy here, these growth ETFs, this should probably be a passive investment. This is long term. You probably are not going to be changing this up. However, if you have so many, you're probably changing this up. So me personally, I would pick my favorite 3 or 4, maybe 5, and call it a day. You're hopefully doing your research on this section and you don't need to spend a lot of time on this, right? You don't, the whole Warren Buffett quote, when you buy a farm, you don't go and look and watch the crops grow. This is supposed to be passive. So you do your research, you know what Lockheed Martin does, you know what JP Morgan does, what PepsiCo does, and you passively invest into it. You dollar cost average. Then it's just passive, right? But then the third thing, this is where you have fun investing in the stock market, right? You see what the price of Shopify is doing. You see where Lemonade and Tesla and Bitcoin is at, and you follow it there. So you feel like you're part of the game, whatever you want to call it. So that's my view on it. I think this is a really great approach to investing. A lot of times we take a one-size-fits-all approach, and that's just wrong. In my opinion, it's just wrong. We shouldn't do that. We should bucket it. I think having different buckets of how you're invested, diversification, I think that's how you be successful in the stock market and when it comes to long-term investing. So yeah, Daniel, I think this is great. Thank you so much for sending over your portfolio. All right, the last portfolio is from Investing Sensei. He writes, "Hi Jake, always love seeing your videos and supporting your channel. I figure since the Review My Pies is a fun series and we are investors that are constantly learning more and more every day, I wanted to send you my pie like you mentioned a few weeks ago. So my portfolio is currently concentrated into dividend growth investing where I want to achieve a few things. Passive income, of course, capital appreciation because it never hurts, tax benefits, qualified dividends, great, and getting a raise for doing absolutely nothing. I love this. These are all really, really great reasons why investing in the dividend stocks is such a great idea. Really, really great things about dividend investing. Anyways, I'm currently 28 years old and have about 20 to 30 years before I plan to touch this money, so my portfolio is really concentrated in the low dividend yield companies, but that have low payout ratios and double-digit CAGRs. Really great. So hopefully I see massive returns in 10 plus years from these low yielders. This is really important. So the CAGR is the compounding annual growth rate. Really, really important. The payout ratio is how much a company is paying in their net revenue to investors. So if they have a low payout ratio, that means they're able to increase and grow their dividend faster. When I say they, I really mean the company. So I have been investing since January of 2019 and have been sharing my journey on YouTube since September of 2019, back when my portfolio was in the low 30K-ish. As of today, the portfolio is currently about 168K and I've invested about 94K. Everything else is unrealized gains. I don't want to pay Uncle Sam yet. That's really great performance, by the way. Really, really great. As of today, my portfolio is generating about $2,700. It goes up every week since I dollar cost average $100 every week. So it might be higher by the time you review my pie. Okay, very cool. So you have it broken down by your projected income by month, day, week. That's kind of cool. That's a way to view it, right? Projected hourly working wage. That's a cool way to view it. Just a note, ignore the NIO and Tesla positions in my pie since they might be sold in a year or two for long-term capital gains. Also, this portfolio is in a taxable account, unfortunately, due to the fact that I make sure to max out my Roth IRA and my HSA. Gotta love the triple tax advantage accounts. Yep. And due to my age, since I do believe in the eighth wonder of the world, I have both this dividend growth portfolio and strictly only growth portfolio here. I have positions in Tesla and Facebook. I think you sent me another email that you're going to be adding these two positions, NIO and Tesla, to your REIT. All right, so let's take a look at your portfolio. I don't know why we can't see the historical performance. You have a decent dividend yield. I'm assuming with the allocation so heavy in tech, and you got Tesla and NIO in here, you're probably beating the S&P 500. I'm assuming. With this dividend yield, you're probably beating the S&P 500 because you have more allocated to tech. But let's take a look at it. You got 35 holdings, really good. You have no ETFs because you have a zero expense ratio. Let's look at your tech. Oh my gosh, 500%. Yeah, 100% you're beating the S&P 500. Okay, so what do you got in here? You got your Microsoft, Apple, Nvidia, NVIDIA and Skyworks. Okay, this is really interesting. So you said you wanted to focus on the total return. You want to focus on those double-digit CAGRs. These are all really, really great companies. I think it comes down to your risk tolerance, right? Having 30%, broken up into 4 companies, that's a lot of allocation to just 4 companies. So to put that into perspective, you got 33 times 30. That means you have just around 10% in Microsoft. 10% of your portfolio is in Microsoft and in Apple. In my opinion, that's a little bit high. From a risk aversion perspective, I think having 10% in one individual stock, Apple and Microsoft, if you were to invest into a company at 10%, I think Apple and Microsoft are great candidates, but still, for my personal risk tolerance, I think that's a bit high. When you're focused on dividend growth investing, you generally want to have no more than 5% in one individual stock. In most cases, you're going to manage your risk most efficiently if you follow that rule of thumb. Let's take a look at, and 30% is also high to have in one sector, but given your time horizon and the type of companies that you're invested in, I can understand the reasoning behind it. So let's take a look. You got consumers at 20%. People think typically of consumers as like Coca-Cola, growing at 3%, 5% a year. You definitely have some growth consumers in here. Right on. You got Costco, Disney, Starbucks, Home Depot, McDonald's, Pepsi, Procter & Gamble, Leggett & Platt, Clorox, Ultra Group. You set this up perfectly. With your time horizon, you want to optimize for tax efficiency, focusing only on qualified dividends, which you're doing. You got your higher growers in here and your lower growers in Clorox and Leggett & Platt, Procter & Gamble. I think this is really strong. You could even take a look at some that I like. I like Walmart and Target. Those are really, really great growth consumers. But yeah, every single one of these are really great companies. Industrial is what you got in here. You got your 3M, Lockheed Martin, Union Pacific, Honeywell, Waste Management, Caterpillar. Okay, maybe what you want to consider doing is reevaluating 3M. 3M is a great high dividend company today. It's also a great dividend growth company, but take a look at what you had here in your consumers, right? You had your fastest growers here at the highest and your slower growers down here. You may want to consider doing the same thing here. Lockheed Martin is a fast grower. Union Pacific, Honeywell, Waste Management, and Caterpillar are growing much faster than 3M. So maybe what you want to consider is bringing down 3M and increasing Caterpillar, Honeywell, Waste Management, etc. So that would be my opinion there, is constructing the industrial slice like how you have your consumers in terms of your higher growers at the highest allocation. Let's take a look at your utilities. You got Duke, American Waterworks, and Southern Company. These are all really, really great ones. One that you may want to consider is NextEra Energy. NextEra Energy, for a long-term time horizon focused on growth, is really, really great. But these are 3 great companies. Healthcare, what you got Johnson & Johnson, AbbVie, Pfizer, United Healthcare. Yeah, I can't really say anything against Johnson & Johnson being the highest because it's like one of the best companies, dividend companies out there. I think it's fine. Financials, Visa, JP Morgan, Bank of America. Visa, you got 2 banks in here. Maybe something that you could consider is maybe some other like insurance companies, right? Or investment companies. I don't know, maybe like a T. Rowe Price or like Standard & Poor's, for example. All right, now let's take a look at your real estate. You got 3%. You did mention in another email that you were going to be consolidating and bringing, selling out a Tesla Neo in the future and bringing real estate up to 5%. You got 2 in here in Realty Income and American Tower. Okay, these are 2 really, really great REITs. I personally, I would consider maybe lowering Realty Income. It's a great REIT, but I think you can get more growth from different sectors. There's 2 that I really like. I like DLR, Digital Realty Trust, and I really like Prologis. Prologis, ticker symbol PLD. I think those 2 would make a great addition to this portfolio if you want to focus on the growth and the long-term growth of the total return of your investment. 2 really, really great REITs. There's others out there that I really like. I like WP Carey, ticker symbol WPC, and there's a few others. But that's definitely a great way to start, is DLR, PLD, and then you got AMT in here as well. So yeah, that's something that I would consider. I think in your real estate one, you could take a look at those. And then in materials, you got APD. Yeah, keep it simple, man. I think this is great. Well, Investing Sensei, I think this is great. You have a manageable amount of holdings in your portfolio. You have 35 holdings. You're optimizing for qualified dividends, right? Because you have a low allocation to real estate. You're optimizing for growth, for the total return. The only thing that I would consider is, as I mentioned with Microsoft and Apple, having 10% in one company as a dividend investor, that's just a little bit more risk than I personally would feel comfortable in my portfolio. Because you have to remember, right, when you live off of your dividend portfolio, you want to optimize for not only tax efficiency, for diversification, but for risk management. And that's something you may want to consider as you get closer to living off of your portfolio. For now, if you got 20 years or 15 years before you live off the portfolio, hey, go for it. But I think what you'll find is once you get closer to living off of the portfolio, I think that risk management is going to play a bigger role. But once again, thank you so much for sending over your portfolio. I think it is so cool to see how different people are viewing this topic of dividend investing. Dividend investing is not a one size fits all. It really comes down to your goals, your priorities, your risk tolerance. We can be talking about the exact same thing, but be viewing it in a completely different way. Like whether we're talking about zucchini or zucchini, or avocados or avocado, at the end of the day, we're talking about dividend investing. And that's what I love about this YouTube channel, is interacting with all of you. Thank you so much for watching. I hope that you learned something new, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.